Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 17th of April, and we have Brent crude oil trading below $90 a barrel, but one would have to say not too far below, with the big dramatic news loitering in the background. It does feel like the markets are fairly timid as a result. Let's kick off with Jamie Ingram, Middle East editor, senior editor rather, the Middle East Economic Survey. Jamie, your thoughts now, I don't know, is it day 4 or whatever number we want to put after the big weekend, and the oil markets still sort of taking it in its stride? Are we being nonchalant, do you think? Are we being a bit too soft on what the possible outcomes are here, or is there just so much idle supply that that this is not a big event for the oil markets?
Thanks, Sean. Good to join you again. Yeah, I mean, pretty stable prices so far. I think you've got to say that, the oil market is working pretty efficiently. Very low volatility despite an unprecedented military action within the Middle East major oil producing area. There's been a lot of focus on, Iran saying that its response to the previous Israeli attack is now over. But it's clear that we are now in a new era. Previously Iran was directing a lot of attacks against Israel through proxy groups. Now they've crossed the Rubicon. They have actually very clearly, visibly, however choreographed it was, made a direct attack themselves against Israel. I think there's two questions now. One, obviously, everybody's waiting to see what Israel's response will be to this. Secondly, what is the bar for further Iranian attacks against Israel? There have been some comments from Iranian officials suggesting that kind of any attack by Israel against Iranian assets, interests in the region, is sufficient to trigger further direct attacks like this. That's a very low bar. I think that if Iran actually adheres to that new mantra, theoretically we could be seeing multiples of these attacks flying across the region, lots of drones, lots of missiles. If that happens, then clearly, that's going to push the geopolitical premium on prices up significantly. There's big, Iran, clearly Israel was able to defend pretty well against this attack. But Iran is, it's been able to study how Israel responded to that, where the missile defense systems are, how they operate. Also, there's a massive cost asymmetry within this. There's been estimates that this cost more than $1 billion for Israel to defend against this single attack, whereas the cost for Iran is significantly less than that. So again, as we're seeing with Ukraine, there is that cost asymmetry. How much can how long can Israel continue to defend against this before there's a real economic impact, and before we start seeing stockpiles being drained away?
Mike McGlone, senior macro strategist, Bloomberg Intelligence. Meanwhile, back at the ranch, the U.S. bounces along in jolly form, and so much so that the Fed Chairman Powell has to eat his rate cutting lunch and once again push the easing cycle further out into the future. Your thoughts on that, on his commentary yesterday, that outlook and its ramifications for the oil markets and commodities in general, perhaps?
There's the high price cure that really affected commodities starting with that peak from 2022. It's still the overhanging headwind for commodity prices is now afflicting the stock market. It's no coincidence that the stock market made record highs, crude oil bounced, and inflation sticky, and all those expectations for rate cuts are diminishing. So to me, that high price cure is trickling down to the stock market, which is part of the next stage of the bear market for crude oil and most commodities, with the exception of gold. And to me, the key thing that Powell didn't tell us this, but we all know, I think there's very little reason for them to cut rates until the market goes down. The stock market tells it to by going down. I mean, it's sticky inflation, massive, pretty speculative excesses. And it's that process, I think, is just getting started. So one thing you have to point out is crude oil right now around $85 a barrel WTI, at least recently, is very near in terms of managed money net positions, futures, hedge funds. Total petroleum positions are about 15% of open interest. That's right about where it was with the peak last year on 95. So 85 now is about the same as 95 last year. And the risks, I think, are very similar. Prices drop that way. And the key bottom line for all markets right now is beta. The S&P 500 looks like it's finally starting to back up a little bit. It's way overdue for a 10% correction. My signals are it should continue lower. And to me, that's the overwhelming force for all commodities. And it's part of the reason I think crude oil is going to continue the bear market and head still towards $50 a barrel, and gold's going to continue rallying and head towards $3,000 an ounce.
Jay Maru, Head of Market Intelligence and Analytics for the Middle East and North Africa from Vortexa. Jay, are we seeing anything? I mean, starting with obviously Vortex's magic sauce of being able to look at where all the ships are and where they're going every day and not going. Is there any cuckoo in the coal mine there? We obviously saw prior to the events on the weekend that the Iranians detained a container ship in and around the Straits of Hormuz. Are there any other signals, any other signs in the shipping world that might give us some guidance of where we go next on all of this?
Hey, Sean, thanks for that. Good morning to you guys as well. I think it's very interesting this cool down in or lack of response in oil prices following the attacks, and I think that's acknowledgement, at least within the oil industry, that to date no significant infrastructure has been attacked or really threatened. Right? There's no imminent risk of closure in the Straits of Hormuz. There's no change in oil flows or oil production from Iran at this stage. Looking at the data that we have, Iran's been exporting plenty of oil recently, and I think our latest figure for March was somewhere in the order of 1.4 million barrels a day. So that's very high compared to year ago levels. That in itself is a sign that there's so much oil coming out from Iran at the moment. Most of it's going to China, and it isn't really in anyone's interests for an escalation in this to affect energy supply. And that's why it's clear, given the response from the US and from other nations, everyone is calling for de-escalation. And on the shipping side of things, we've seen Iran continue to export at normal levels. One interesting thing that I do want to point out, though, is on the Iranian side, we have seen a little bit of a build-up in floating storage, in Iranian crude oil floating storage. In March, we saw that go up by somewhere in the order of 10 million barrels or so. What that suggests, and I think we'll probably come to this later on, is a little bit of weakness coming in from China on the buying side of things. And I guess that probably feeds into the wider comment about bearishness on oil prices because of demand issues.
Jamie, we had a rather unusual or certainly rare occurrence today. The UAE and Saudi Arabia issued a joint statement on the situation in the region, calling for maximum self-restraint from the dangers of war and its dire consequences. Your thoughts on that statement, on the position of the major neighboring countries in the region? Of course, some of the world's biggest oil exporters. Does their voice carry weight, you think, into this equation, Iran, Israel, US axis?
Well, it's worth looking at what's happened over the past year and a little bit on that front, Sean. Clearly, we've seen Saudi Arabia and the UAE move towards rapprochement, normalizing relations to some extent with Iran. That has really paid off over the last year, certainly since the 7th of October attacks. There have been no instances of aggression from Iran or its proxies against Saudi Arabia or the UAE, which is in marked contrast to the situation, say, 5 years ago, where proxy groups, there was clearly the infamous attack on Abqaiq in Saudi Arabia, but there were lots of smaller level attacks against Saudi infrastructure. There was attacks against tankers offshore Fujairah and in the Gulf of Oman as well. So these guys, through negotiating with Iran, through opening up dialogue with Iran, they have bought themselves security. That is something that they are intent on making sure very much stays the case as this escalates further. So yeah, this is in keeping with expectations, quite frankly, as Saudi Arabia now is in a position where it's not just got long-standing relations with the US, but it actually has relatively um, affable relations with Iran that is a key strategic priority to maintain. So these kind of comments, I think we can expect to see. Clearly we saw China also comment on this situation, which probably carries more weight than anyone else at the moment, as Jay stated, it is the dominant purchaser of Iranian crude. So when they start saying, look, let's steady the ship on this one, I think that if any voice is going to carry weight in Tehran, that's the one.
Mike, we're all sort of compelled to be somewhat of political risk analysts or geopolitical risk analysts at the moment, whether we're selling corn in Oklahoma or oil in the Gulf. But nonetheless, this is a big election year for the United States, for all of us. I mean, there's elections everywhere. India is just about to kick off. It's the world's largest democratic election over the next 4 weeks. But in the US, obviously, looking out to the election and the intersection of these events with the strategy and policy of the Biden administration and or the opposition Trump, how is this going to play out, do you think? We're seeing incrementally every week, every month, that gasoline prices, as we get close to the infamous driving season, are just going higher and higher. Your thoughts on where all this intersects with the political election year that is America?
Well, that's a loaded question. I'll do my best on that one.
I mean, is there anything out there that could turn gasoline prices lower rather than higher, I suppose?
I think gasoline prices will be much lower at the end of the year than they are now. Yes, we're heading towards the peak season. They should inch up into the peak season. That's the way they usually do it. We're probably not going to see a release of the SPR this year. But the cycles for gasoline and energy prices are very poor. One of the key things you can look at is the inverted curve. And that used to matter. But typically, on a global basis, the inverted curve is very bearish for crude oil prices. You look at the 10-year note yield in the U.S., it's about 70 basis points below the Fed funds rate. And then you look at the top other countries in the world, China, Japan, Germany, and India. The average of their yields are about 150 basis points below the U.S. 10-year note. So that just shows a global tilt towards a recession. In the U.S., the pendulum swung way too far last year towards recession. It swung way too far this year towards no recession. And I think it's just swinging back a little bit towards that recession period. And that's what's showing up in bond markets. So as far as politically, I think the market knows that if we do have a second term president for President Trump, it's drill at will. And it's probably, so it's bad for crude oil prices, probably bad for the dollar. He really like bashing the dollar. He's going to be focusing on exports and import tariffs, but typically he's been trying to pressure the dollar. So overall, it's bad for crude oil, probably really good for gold. That's as we get closer to the election. But overall, the cycles I see in markets are crude oil, WTI just can't sustain above 90. Every time it bounces up there, it gets whacked. It's typically how markets work, high price cure. And it's had a hard time sustaining below 70. But I think at some point it's going to tilt down. And the bottom line for most markets is, in a typical cycle, you have to follow what natural gas has already done. It got too expensive. It got finally below the cost of production. That's U.S. natural gas. And now at least has a market that's bottoming and going higher. Similar in corn. Crude oil typically has to get below that cost of U.S. production, below $55 a barrel, to shut off that supply and pick up the demand. And I think by the end of this year, I'll repeat what I said, is gasoline prices will be lower than they are now.
But if we look at just some of the fundamentals, Mike, going into the second quarter, obviously maintenance season, the refining, we've got obviously hurricane season coming, which is always an unknown, but ultimately it is a threat to the bullish side rather than the bearish side. But in terms of some of the structural seasonal pieces, never mind the geopolitics here, do we look like we're in a tightening period for middle distillates, for gasoline, aviation fuel?
The opposite. It's always, the cycle is towards, look at diesel demand in this country. It's stagnated, it's dropped to the same level it was 10 years ago. Unleaded gas demand is declining, it's dropped. Paperboard, corrugated box demand, key indicator like diesel of the grease of the economy is plunging like it did there in 2007 and 2008, the Great Recession. So organic signs of pickup are the exact opposite. The inverted curve, leading indicators, things like that used to matter, I think are going to kick in. And the bottom line is you have to see that U.S. stock market give up a little bit before the dominoes start tumbling. I think they're starting to tumble.
Jay, looking at the events, obviously, of the last week, and this has been a progressive ratcheting up of the regional sort of tensions. But just wanted to most notably the detaining of the Iranian detention of the container vessel in the Straits of Hormuz on Friday, I think it was. Which sort of just put a little bit of a reminder that there is a thing called the Strait of Hormuz, and it's a pretty important piece of water. But obviously, we've been dealing a lot with the Red Sea, and I just wanted to get an update from Vortexa and from your perspective. How stressed is the Red Sea traffic now? Rates, insurance, etc. And is there anything looking like that could be a stress on the strait? Is there any increase in container rates going into the Strait of Hormuz? Is there any aftermath of the event of the detention of the ship in Iran waters that would signal, it could go the way of Red Sea rates and insurance?
Yeah, so I think it's very important to distinguish between the impact of risk to Straits of Hormuz versus Red Sea, right? So in the Red Sea, we've seen attacks, we've had the redirection of flows take place, and now the traffic in terms of what's flowing through the Red Sea on the oil side, pretty much the only thing that's coming from north to south in the Red Sea is Russian cargo. And going from south to north, sometimes you'll see some flows of intra-Red Sea, intra-Saudi cargoes, intra-Middle East cargoes, but there's almost little to no activity heading towards Europe or heading towards the west from the Middle East or from Asia. The Straits of Hormuz is a completely different scenario, and I think.
But just to pick up on that, sorry, on the not going north through the Red Sea, are they going round the Africa, the long way round, so to speak, or they're just not going at all? What's the flow in general?
It's a combination of things. So on one hand, yes, tankers are going round, especially diesel and jet cargoes, to get to Europe via the Cape of Good Hope. But obviously that incurs extra costs, extra time in getting those shipments there. So that has made the arbitrage opportunities from the Middle East or from Asia into Europe much more difficult than they were before. And actually, at the same time, there are these more wider macro concerns, as Mike mentioned, when it comes to diesel demand. And so it's almost the case that these flows are not as large as they were before, but it's also because they don't need to be as large as they were before. If we look at pricing, if we look at what's happened with the time spreads for diesel in Europe or heating oil in the US, they're both heading weaker. They're both heading into contango, which suggests, as Mike said, a kind of mini leading indicator to weaker product demand in the region. Going back a little bit more on the comments of gasoline, I think it's also important to note that one of the main arbitrage plays that happens at this time of the year as the US is ramping up its gasoline demand is there's this typical flow of gasoline from Europe to the US. But those flow volumes have been very low so far this year. And actually, we're seeing more and more gasoline build up in ARA at the moment. So that really suggests a weakness in this gasoline market. So yeah, when it comes to product demand, there are some concerns over gasoline and diesel demand, especially when it comes to Atlantic Basin.
Let's go to the survey question and get a sense of still trying to sort of read the tea leaves on what it means for these the rate cuts not happening. We started the year with 7 rate cuts expected. As we go deep into the second quarter, it's hard to see when a rate cut, at least in the Fed's eyes, might come. So what does higher for longer mean for oil markets? Higher rates for longer mean for oil markets? Is it bullish? Is it bearish? Or is it no impact? If the price of money stays higher for longer, does that restrict economic growth? Does it obviously the idea that companies have to spend more money on their debt, people have to spend more money on their debt rather than on buying hamburgers or whatever they might do, and so it restricts economic growth, and so that's bearish for oil prices generally. But if the U.S. economy is doing so well, rates stay higher, that is potentially bullish or no impact. So let's get your thoughts on that. Jamie, looking out, obviously we're coming into the period of all things OPEC, who've been sort of, I mean, all these countries in our neighborhood here are OPEC plus countries, and oil supply is what it's all about at the end of the day, getting to market. But OPEC plus looking through the sort of all the fog of war, or the fog that's currently there, and the supply and demand fundamentals. Is this looking like a balanced market where OPEC plus could start to ease some of its cuts into the second half? A number of research houses indicating that there's a much greater tightness just around the corner. Your thoughts on where OPEC goes, and reading the tea leaves and all of this in terms of their next move?
Yeah, there's still what is it, a month and a half or so now to go until OPEC meets 1st of June to for the countries that are participating in the voluntary cuts to decide on whether to extend that 2.2 million barrels a day in full into the second half of the year or not. You know, they've already said that it will be a gradual restoration of volumes when that does happen. So it's not like there's this cliff edge moment when bang, significant amounts hit the market. I think that what you said regarding, turning the corner, that's the key issue here. If that corner arises before the 1st of June and there's clarity for OPEC, then yes, we can see them move on to the next stage. But they really have taken on board this see it and then believe it mantra when it comes to the cuts and easing them. So if there's still significant economic uncertainty, I suspect that we will see them decide to play it safe. The key issue for them is, of course, maximizing oil revenues. That basically they want to make sure that they don't take action that pushes prices back down below $80 a barrel. So if we're still stuck in this position here at the moment where prices flit up and down around the $90 mark, there's a lot of uncertainty. Is there contango emerging in some of the key products? They're probably going to press pause, maybe at most take a very gradual, an extremely gradual response to releasing volumes with, let's say, they're going to say that they're going to gradually release them over the course of the remainder of the year, with another meeting in a few months' time to decide on whether to continue with that or to pause again. So that's the way that I see it at the moment. Given the economic uncertainty, it will be a very cautious approach from OPEC in the next couple of months.
Why change if it isn't broken, I suppose.
Exactly.
Mike, looking out at the U.S. oil production, obviously that's another big factor in this consideration of a balanced market after bumper sort of recovery in U.S. oil production last year. It looking a little bit, quite a significant bit more lower this year. Is that likely to play out for the rest of the year? U.S. oil production going to essentially remain flat, maybe up a little bit in new supply. But your thoughts on the outlook there, and if that forecast is actually coming through, that the increase in U.S. production will be relatively minimal this year?
It's one of the most enduring trends in markets, and that's the increasing excess of U.S. and Canadian supply over demand in crude oil liquid fuels. I've been watching that trend for about 20 years. It's continued higher, and it accelerates when prices are well above the cost of production, which they are now, and it decelerates when prices drop below the cost of production. So I don't see anything but it continuing. The trends are very poorly, as we noticed. Demand is declining, most notably in U.S., and supply is increasing. It's continuing. So the excess right now, U.S. and Canada, crude oil and liquid fuels is about 6 million barrels a day. The excess of OPEC spare capacities, as Jay or Jimmy might be able to say, it's closer to 7 million barrels today. It's almost a 10-year high. You see the trend there? It's not good for crude oil prices. So OPEC doesn't control the market anymore. Leveraged futures do. Leveraged futures traders. And they're about as long as they've been since last year's peak, which means they have a lot of long liquidation to kick in. If something bad doesn't happen in the Middle East, if we don't have a cut in supply, if the stock market doesn't keep going up, they're going to be hitting those bids at some point. It's just a question of when. But the key thing to remember about that trend that has been the major suppressant pressure price for crude oil prices since the peak in 2008 is accelerating. and it typically takes lower prices for it to revert.
Jay, just sort of looking at the point we mentioned, referenced earlier, where is China going, and some of these bigger sort of infrastructure logistics things that had a kind of a tightness on the oil market, which was the Panama Canal, the drought that has restricted traffic in the Panama Canal over the last 6 months. That seems to be easing. The Red Sea still disrupted, but ultimately cargoes are making their way to market longer, maybe taking a bit longer, but ultimately it isn't the stress unknown event that it was. So it looks to me Suez and Panama Canal are operating in some sense of being at least absorbed into the market and the market outlook. China seems to be a little bit of the unknown. How good will it be? It's seeming better than it was. The forecast was earlier in the year. Your thoughts on, do we see anything in the shipping rates, anything in the in that space, tanker rates that might tell us where that sort of global trade picture is at the moment?
Yeah. China, obviously, given the size of its oil imports, is the most important consumer for the market to look at. If we look at our own data and if we try and understand what's happening with apparent oil demand, what we did is we looked at imports minus stock change, and actually what we see is China's apparent oil demand isn't looking great at the moment. That really suggests that there isn't that much growth in the economy that's taking place on oil demand. Somewhere in the order of 10.2, 10.3 million barrels a day. That's where we put crude import demand in March, and that's well within the seasonal range. And actually looking ahead to the second half of the year, we think at best it will be similar to year ago levels. So when it comes to China importing much more crude, we're not very bullish on that. Only thing that could change that if there's a significant decrease in the price, and obviously Chinese being very opportunistic buyers, they'd be quick to pick that up. But that hasn't really happened yet. Speaking to some of our wider network, we're hearing that some of the Iranian crude that's being offered is being offered at deeper discounts than usual to some new buyers. And what that suggests to me is that even with Iranian crude being priced so cheap, they're struggling to find buyers in China that are willing to pay even below market rate. So they're going to have to dig deeper to get those barrels into China.
How about Russian crude? Still a lot of Russian crude making it onto the seas.
Exactly. I was going to just about to come to that. So with Russia, what we've seen is exports stay pretty much the same level that they have been on a seasonal basis. It doesn't really look like Russia's doing anything dramatic at all when it comes to reducing exports. If we see Russia's main buyers of crude, pretty much it's China and India. We've seen India scale back a little bit over uncertainty and fears when it comes to insurance and shipping and risk. China hasn't really done that at all. And the reason why it scaled back in some parts is just a function of cost rather than anything else. So China is continuing to import from Russia, but it's continuing to do so on a very opportunistic basis.
Well, we're going to have to leave it there as we started Brent just below $90 a barrel. It is there's bearish Fed's position higher for longer, bearish for the oil markets. We'll put that out on social. I mean, these are increasingly difficult times to try and read the normal, Fed does this because of, inflation or rates do that. Why is gold going to 3,000? And we have Donald Trump, the head leader in the polls for U.S. presidential election, sitting in a courthouse in New York, scanning a jury. We've got the UN telling us today that they can't stop the famine emerging in Gaza. I mean, these are incredibly unusual and horrific in ways times, and it's difficult, obviously, to sort of assess the usual collection of data points to come up with general, forecastable outlooks. But that's the challenge, isn't it? Putting all of these things in the bucket, and despite all of these different things, oil prices seem relatively calm, as they did for much of the first quarter in the low 80s, stuck there happy. Now we kind of sitting on the balcony of 90 and seem to be taking in the sun before deciding what's the next direction. But we'll leave it there. Thank you as always, Mike McGlone. Really great to have you back at the table. Jamie Ingram in London and Jay Maru here in Dubai. Thank you so much for your insights this morning. Have a good day. All the best.
Thank you. Bye.
Bye.